Today we're going to talk about real estate financing. And when I mention real estate financing, what comes to mind? Obviously, it's a mortgage. We're going to borrow money. Most people do not have cash to pay for their house. So there has to be a way and a system set up that allows us to borrow money and have it some kind of standardized way of getting this done. Some laws that rule how it's done to protect consumers are all part of this whole picture. So many homes in the U.S. are bought with borrowed money, and there's a huge lending industry has been built to service the financial requirements to home buyers, banks, lending institutions, tons of them. It's important for the real estate professional to be knowledgeable about real estate financing programs and products in order to provide quality service, especially when representing a buyer. When you do your real estate classes, you will spend half a semester on real estate financing. This is an important part of the whole real estate picture, understanding how people can borrow money. So again, we'll spend 9 weeks on real estate financing. So you'll feel more comfortable with what happens with this aspect of buying a home. It's important for the real estate professional to be knowledgeable, like I said, about real estate financing programs and products in order to provide quality service, especially when representing a buyer. Not only that, but it's also important to understand when you have qualified somebody, what can they afford to buy and how are they going to afford to buy that. So that's all part of this financing picture. So learning objectives are describing the various aspects of housing affordability, including mortgage terms, the ability to pay, and investment and tax considerations. And obviously we have laws today that are changing some of our tax considerations. We're going to describe the terms, conditions, and use of promissory note. We're going to talk about and explain the elements and use of security instruments and describe the mortgage deed of trust and the roles and rights and obligations of the parties involved. We're going to describe the various types of real estate financing. We're going to explain the distinction between a judicial foreclosure and non-judicial foreclosure and the process involved in each. And we're going to describe the various consumer protections related to home ownership. Again, we're going to go through this in one chapter tonight, but this is something that you'll learn in half a semester of the real estate appraisal and finance class, because it is a big piece of housing affordability, of buying real estate, is this whole piece of the finance picture. So when we talk about housing affordability, what comes to mind? Think about this. What's affordable? What's affordable for one person versus another person? Years ago, I used to hear stories about people that would buy a house, beautiful new houses in suburbia, $200,000 and $300,000 homes. They'd buy them, but they couldn't afford to furnish them. They'd live in them as empty houses. Is that really a way to live? And that's something that, as a realtor, you can't tell your people, your clients, either buyers or sellers, how to afford or how to live in a house and how to own it. But you do need to understand the affordability. When can they qualify for a mortgage? How much mortgage will they qualify for? Is it 28% of their gross income? What's the level? And it also depends upon who's the lending institution. What kind of financial program are they going to use? Are they doing regular financing? Or are they going to be doing FHA financing? Are they going to be doing VA financing, HUD financing? What are the options that are out there and available to people to making this whole housing affordability puzzle come together? Some of the mortgage terms we're going to talk about. When you get into a mortgage, who's the mortgagee, mortgagor, what's interest, what's principal, and when you sign on the dotted line for a loan, what are you actually committing to pay for? We're going to talk about the ownership expenses and the ability to pay, principal, interest, taxes, and insurance, which is the PITI. When somebody's making a payment on a mortgage, they're going to be paying the principal and interest, but very often they have to pay taxes and insurance into the escrow as part of that mortgage. The reason being is the mortgage companies want to know that the taxes and insurance are paid They want to make sure that you're paying them, so they ask you as the mortgage holder to pay into escrow so that they can control and make sure the taxes and insurance are paid. Taxes get paid because they don't want the tax to take a priority lien over the mortgage, so they make sure the taxes get paid. They want insurance paid because if something happens, a catastrophe happens to the house, they want to make sure it's insured so that it can be repaired so that that mortgage can ultimately be made whole. And there's something called the debt to income ratio. This is what we talk about, the DTI. How much debt to income can you have? Can you afford a house? A big problem today with our young people trying to buy homes is they have student loans. There's a lot of debt for that, and that impacts this whole debt to income ratio. How much debt are they carrying when they get out of college and they're starting to save to try to buy their first home? Other investment considerations we have are tax deductions and the benefits of that. This is the primary reason people buy homes is because versus renting. If you own a home, you're getting appreciation of the home. You're not just giving the money to a landlord and kind of pissing it away, but you're also getting a tax deduction for that interest that you've got on the house. So this is an important part of home ownership. It's something that banks and the National Association of Realtors, anybody that's associated with a realtor and the real estate industry is going to fight for that tax deduction for a long time because that's one of the things that makes this market work. Promissory note. We sign something called a promissory note. That's part of this whole mortgage. It's a negotiable instrument. So once we've signed, that becomes the negotiable interest instrument that a bank can then sell. They've got a commitment from a homeowner that they're going to be paying, and that is worth something to sell in the open marketplace. And that's the whole thing about the secondary money market, secondary mortgage market. We sign up. We're on the first market where we're getting our loans produced. We're sitting down with a loan officer. We're making the loan, but very often, right after we've closed on a loan, that loan has been sold in the secondary mortgage market. So it's becoming a negotiable instrument. Interest, what we pay in interest and how we pay interest. Some of that interest rate is determined by the Federal Home Loan in Fannie Mae and Freddie Mac and the Federal Home Loan Bank and the Federal Reserve. They're all making decisions about the interest rates and how that's going to impact home ownership and loaning rates. There's something called usury. We only have rates that are a certain level based on our income and our credit ratings, but once they go above that, they become usury rates, and therefore they're kind of outlawed. We cannot have usury rates. Usury rates is something that's identified with this Quicken Loan, or not Quicken Loan, but the loans where you're payday lenders. They talk about usury rates, where they're charging an awful lot of money to make these quick loans. So usury is a term that's bad in the lending market, and we want to avoid usury. Loan origination fees. They range, but they're generally consistently around the same type of price so that mortgage companies can stay competitive with banks and credit unions. They have a loan origination fee. That pays for somebody to underwrite the loan, to do the paperwork, to get the information together, to put the packet together to make that loan happen. That's a loan origination fee. Discount points. Discount points. If you're going to do an FHA or a VA loan, you'll pay discount points to be able to qualify for part of that program. And typically it's the seller of the house that's going to pay the discount points so that the buyer can do an FHA or VA loan. But you can also, as a consumer just trying to buy a house, you can buy down through discount points. You can buy down your mortgage rates. Sometimes you don't want to do that because the mortgage in general is the lowest and the cheapest way we can borrow money. So typically we're not buying it down with the discount points and interest rates. We want to, if we've got that kind of money, we're using that to pay off higher interest rate loans, or we're doing other investments. But discount points are all part of this loan process. And then prepayment penalties. In Ohio, we don't have something called prepayment penalties when we're dealing with residential loans. But when we deal with commercial loans, we are dealing with prepayment penalties. And the reason that is the bank has a yield rate. They make a certain amount of money off of lending to you, and they want to know that you're going to hold that loan to term. and therefore that's where they're going to make their money. If you prepay that loan, they don't make their yield, and that's why they do a prepayment penalty. That's to help the bank make the money that they're committed to making when they generate the loan. It's a security instrument, the mortgage. We have a mortgage loan that's actually being, again, through a contract. We have hypothecation that happens through this process. And then we have something called a lien theory, where our mortgages become the primary voluntary lien on a property. They're typically the first lien. The mortgage company wants to make sure that the paperwork gets recorded right away after your closing so that they are the first lien holder. But taxes will always take preference over a mortgage. They always have priority. So we have the mortgage, which is two parties. Typically when the money is borrowed, we have the mortgagor, who's the borrower. There's a note and mortgage, and then the mortgagee, who's the lender, and then the loan is repaid. And then when money is repaid, it flows the other way. The mortgagor borrower pays the loan to the mortgagee, and then they get a satisfaction of mortgage. It's very important, too, when you go through this process of buying and selling homes, that if you're representing the home seller, that as a good realtor, you're going to follow up and you're going to get a satisfaction of mortgage. You want to make sure that that gets recorded, and that the people that are selling the home get a copy of that satisfaction of mortgage. And you tell them to file that with their important papers. This is how you'll set yourself apart from other realtors. You're going to be able to say, I've got a very important document for you. It's a copy of your satisfaction of mortgage. Keep this with your home papers. It's very important that you keep it. 10, 20 years from now, somebody may come looking for it, and it'll be handy to have it. Part of the chain of title. We have deed of trust, title theory, where if you're buying on a land contract, we're working typically with a deed of trust. And the deed is taken out over a period of time while the land contract is paid off. And the title theory relates to how you actually become the title holder when you're dealing with this deed of trust. So deed of trust is typically three parties. We have the trustor, who's the borrower. The beneficiary is the lender, and then the trustee holds the naked title until that land contract or loan is paid off over time. And then when the money is repaid, it kind of goes back the other way. The trustor and the beneficiary, and then the trustee releases the deed of reconveyance, and typically there's another deed that's issued back to get this loan, the actual title transferred. So, when we have real estate financing, we have the duties of the borrower. You're borrowing money. What are you required to do? Well, you're required not only to make your monthly payment and carry insurance and pay the taxes, but you're required to take care of the property, keep it in a certain state of maintenance and care. And if you don't do those kind of things, there's provisions for default. So typically, your home lender may come by once a year and do an inspection, or they're doing a drive-by inspection of the property just to kind of make sure and look and see that it's being taken care of, that it's not in a state of disrepair. They're paying your taxes and your insurance for you because they want to make sure those things are done. But the default provisions are there, so if you fail to make payments or fail to take care of the property, they can call default, and they can come back and force foreclosure on it. We have the assignment of the mortgage, where a mortgage years ago, we used to assign mortgages. When we were doing mortgages at 12 and 13% was the going rate, and you had already locked in and you'd owned your house for a few years, you had an 8 or 9% mortgage, you could assign your mortgage. Today, typically, we don't have assignment of mortgages. We have something called a due on sale provision in most of our mortgages, so they're no longer assigned. But we can do some assignments with FHA and VA mortgages. Again, you've got to read the note and know what you're allowed to do. This is part of learning the business. Release of the mortgage lien or deed of trust. There's a defeasance clause, again, and the satisfaction of mortgage. These are the things you want to make sure you follow up and you get taken care of for your sellers. Go after these documents and make sure your sellers get them. And then we have the tax and insurance reserves. This is that escrow money that they want to put aside to make sure that you are paying your taxes and insurance. In addition, if you live in a floodplain area, a flood zone, and you have to carry flood insurance, they might also have flood insurance reserves. So flood insurance would be over and above your general liability and your property insurance. Buying subject to or assuming a seller's mortgage or deed of trust. Again, we used to have this whole provision where you could buy subject to that or assume that. It exists today, but it's not nearly as often. It's very rare. We want to record our mortgage or deed of trust, and we also have what we call the priority of mortgage or deed of trust. We want to make sure it's recorded first in the sales transaction of things, that it gets the first priority. Again, it'll never take the place of taxes, but we want to make sure it's recorded so there's no other liens that are filed against the property. Types of loans that we can get. We can get straight interest-only loans. Some of this you'll see more often than not. You'll see more in commercial lending environment, but we do have interest-only loans. It's not something we encourage people to do because they're not paying down the principal at all, and it's hard to earn a lot of equity in the property if you're not paying your principal down. Most of our loans are what we call amortized loans, and they're fully amortized. In other words, you pay equal payments every month to pay the tax, to pay the principal and interest to ultimately pay the loan off. But we typically are calling them fully amortized loans, and this is most often what we're doing with our residential properties. There's something called an adjustable rate mortgage, the ARM loans. This was part of our problems in 2008, 2009. We had a lot of ARM loans that were out there. They were out there on teaser rates where they were really low interest, and then after the first year or two, then they increased substantially. And a lot of people didn't know that that increase was due, and then all of a sudden the house was no longer affordable. They couldn't afford the mortgage payment. When you had an $800 payment that went up to $1,400 or $1,500 a month, you're almost doubling your payment. And the adjustable rate mortgage allowed that to happen, but people didn't understand what it was about. You can do adjustable rate mortgages, and you can do them very beneficially to the buyer of the property. You just have to know how to negotiate them and what people are getting into. We have a growing equity mortgage. Again, we don't see them happen often in our market, but a growing equity mortgage might be aligned with how your income's going to increase. Your mortgage payments increase as well. Balloon payment, when we have the money all due at once, let's say you only finance it for 10 years, but you might amortize it over 30 years, but the payment's due after 10 years, that would be a balloon payment loan. Again, typically that would be in a commercial product, not a lot in residential. And then a reverse mortgage. This is the thing that my mother-in-law cringes over when we talk about reverse mortgage. Reverse mortgages are primarily meant for people that are over 62 years of age and older that are going to live in their house. They've paid off their house or substantially own their house, but their house is their biggest investment. And all of a sudden they need money to live on. They have medical needs, or they don't want to go into a retirement home. They'll use a reverse mortgage to try to get their equity back out of their house to be able to use that for them to live on. Just because they do a reverse mortgage doesn't mean that it's all gone and done. When they do the reverse mortgage, if they die before they take all the proceeds of the house back out of the mortgage, obviously the mortgage company and the beneficiaries or the family of the person that dies will sell the house, and the bank will get what they're due, and then the remaining will be left to the family. Reverse mortgages, like I said, they're a good product for people that are older, that primarily own their home and it's their largest investment, and they don't have a lot of income coming in when they're elderly and they want to live in their house for the rest of their lives. The reverse mortgage product works. We talk about foreclosures. And foreclosure is the way the mortgage company, the primary default remedy would be to foreclose on a house to get the property back. And obviously, when you put up a house, it is the primary piece of something that's valuable when you sign that mortgage. Sign up for that mortgage. The house is what's going to pay for it. And if you don't pay your mortgage, the mortgage company wants to come back and take that house back through a foreclosure process. There is judicial, non-judicial, and strict foreclosures. These are all different ways about going through the foreclosure process. Typically in Hamilton County in Ohio, we have what's called a judicial foreclosure. You have to go before a court to get the house, to go through this process. And the reason that is there's a lot of protection involved there for consumers, that the bank isn't going to take advantage of them and come in and take the house without some kind of fair hearing and fair process. So again, in our market, typically we have what's called a judicial foreclosure. They have to go to the court, file papers, and have a hearing to be able to get the house back. We have something called a deed in lieu of foreclosure. And typically the deed in lieu is something that you'll hear about more in commercial property than anything, but it also could be called a short sale, which we hear about in residential property, where we go back to the bank and we say we can't pay our mortgage anymore, here's the deed. We'll give you the deed back. We don't expect any money returned for what we've already paid, and here you go, bank, you now own the house, here's the deed back. In residential, we call that short sale. You're going back to the bank and you're saying, I owe you money, but I can't afford to pay the loan anymore. We're going to short sale it and try to get as much proceeds as we can, but it may not end up paying for what's outstanding on the mortgage. So then we can do what's called a short sale. It's selling for less than what the mortgage balance is. When this happens, though, people end up having to still pay the bank. There's two things that happen. They still have to pay the bank the short sale, the short amount, or at the end of the year they get a W-2 that says the bank all of a sudden gave them income in that amount of the short sale, and then they end up owing taxes on that. So be very careful when you're doing this deed in lieu of foreclosure that everybody understands what the ramifications are of it, and that you're advising your clients properly what they can expect. There are some realtors that don't get involved in the short sale business at all. They don't like how it works. They see that where the bank has like 6 to 9 months to own the house and try to take bids to get it sold, but the bank can keep taking bids and keep taking bids. You're not guaranteed you're going to buy it until you go to a closing. And very often people get stuck in this loop and they're wishing and hoping for a house, and all of a sudden they can't buy it. They don't buy it. They're not successful. So there's a lot of reasons why the short sale is something that some realtors shy away from. There's redemption to getting the house back, and then the deed to the purchaser at sale. Again, what's going to happen when you get this foreclosed property back? Redemption is this period where if a property is foreclosed upon, the person the foreclosure happened can come back and redeem it. They can come back in and make good. In Hamilton County, once you go to a court-ordered foreclosure, it says on the court steps, we're pretty much through that whole redemption period. In Ohio, in other states, that redemption period can go on for 6 months to a year after you get the foreclosure sale on the steps. So this whole redemption period makes the foreclosure sale difficult in some states. You have to understand how it works and how it happens. A deficiency judgment, like I said, this can happen when the house sells a foreclosure or a short sale. It's that deficiency amount. They're not collecting all of it. And they go back after you and get a judgment after you. You thought you were able to walk away from it. You lost it all foreclosure, and now all of a sudden they're coming back and say, oh, no. You still got to pay on what you owe. That's the deficiency judgment. We're coming back after you for that amount. So again, we need to understand that these are all the ramifications of allowing a foreclosure to happen and working on a short sale, that you can still have this thing called a deficiency judgment. There are a lot of consumer protections in this business because the real estate financing, the house, is probably the biggest investment most consumers will make. So there is a lot of consumer protection in this whole process of what's going on. And we're getting people, we just got a new person in charge of the Consumer Protection Bureau. So things will change with this presidential administration and how consumer protectionism actually does or doesn't work. They feel like a lot of the laws are too much geared toward the consumer and make it hard for business. So we'll see some changes in that. We have the Dodd-Frank Act. We have homeowners insurance, coverage and claims, and comprehensive loss underwriting exchange. When you buy homeowners insurance, what are you buying? How do you make claims? How much coverage do you get? Rules about the 80% and the co-insurance. You need to advise your clients that they should always insure for its full value. If they're only going to insure for 80% of its value, but all of a sudden they have a catastrophic loss, and they thought they were insured for 80%, but they're really only insured for 50 or 60% of the value, they're only going to get 50 or 60% of the insurance claim. So they need to understand how that works. And the comprehensive loss underwriting exchange is where insurance companies go to learn about the products that they're selling and what kind of losses are happening in the marketplace. Federal flood insurance program, again, it is a federal program. FEMA, though, is underfunded. And some of the things FEMA does is they encourage rebuilding in flood-prone areas. That's not always the right way to be either. In Cincinnati market, we have areas that are flood-prone, and we require people to have flood insurance. Again, owning the house in that market may not be the best place to have that house, so we need to look at that. If you're going to be selling houses that are in flood areas, you need to understand, again, what is the flood insurance, what's required, what's the damage done to the house before when it has flooded. All kinds of things to consider. That is it for real estate financing.